Imagine a hole in the ground that contains $4 billion worth of gold, just sitting there, waiting. You'd think that's an instant fortune, right? Dig it up, sell it, get rich. Except here's the twist. That exact mine could still lose money every single year. It could bleed cash until the company that owns it goes bankrupt, while $4 billion worth of gold sits right beneath their feet. Technically theirs, practically useless. That's not a hypothetical. It happens in the real mining industry more often than people think. And once you understand why, you'll understand something most people never think about. Having something valuable and making money from it are two completely different things. So let's break down what actually happens between there's gold in that mountain and we made a profit. Because the gap between those 2 points is where almost every gold mining company either wins big or quietly falls apart. And by the end of this video, you'll understand a business model hiding inside this industry that most people watching the gold price on the news have never even heard of. It starts long before anyone touches a shovel. A company has to find gold in the first place, and that's a strange kind of gambling. Geologists study rock samples, run surveys, drill small test holes into the ground, and try to guess what's happening hundreds of meters below the surface without actually seeing it. Most of the time, they find nothing worth mining. Industry estimates suggest that out of every few thousand promising sites explored, only a small handful ever become an actual working mine. The rest are dead ends that cost real money and produced nothing. So even before we talk about gold prices or mining costs, there's already a brutal filter. Most attempts fail completely. Let's say a company gets lucky. Drilling results come back promising. There's gold down there. But here's the question nobody outside the industry asks, and it's the single most important question in this entire business. Is it actually worth digging up? That sounds like a strange question. Gold is gold, right? But not all gold deposits are created equal, and the difference between a good one and a bad one comes down to a simple idea called grade. Grade just means how much gold is packed into a given amount of rock. Picture two mountains. Mountain A has 1 gram of gold hidden inside every ton of rock. Mountain B has 3 grams of gold in every ton of rock. Same mountain size, same mining effort per ton, but Mountain B gives you 3 times more gold for the same amount of digging, crushing, and processing. Mountain B is a far better business. Mountain A might not even be worth touching, even though there's real gold in there. This is the first hint of why our opening mystery makes sense. A deposit can be enormous in total value and still be low grade, meaning you have to move an almost unbelievable amount of rock to get a relatively small amount of gold out of it. And moving rock costs money, a lot of it. Assuming the grade looks promising, the company then needs the legal right to mine that land. This usually means securing a mining lease or permit from the government, which is its own long and expensive process. Permits can take years. Environmental studies have to be done. Local communities and regulators have to approve the plans. Some promising deposits never become mines simply because the permitting process drags on so long that the project becomes financially unworkable before a single truck moves. Let's say the company clears that hurdle too. Now comes the part that quietly determines whether this mine will ever make anyone rich. Building it. This is where the real money starts disappearing before a single ounce of gold is sold. Building a modern gold mine is not like digging a backyard hole. It requires roads, power supply, water systems, housing for workers in remote locations, massive processing equipment, environmental containment systems, and heavy machinery that costs millions of dollars per unit. A mid-sized gold mine can easily require several $100 million just to get to the point where it produces its first ounce of gold. Large mines can cost well over $1 billion before they generate a single dollar of revenue. Let that sink in. A company can spend $1 billion and up to that point has made exactly $0 back. All they have is a hole in the ground and a mountain of debt. Now the mine is finally built. Trucks start moving. And this is where people's imagination usually gets it wrong. They picture miners finding shiny gold nuggets. That's not what modern gold mining looks like at all. In reality, workers move enormous volumes of ordinary-looking rock day after day using massive trucks and excavators. A single large gold mine might move well over 100,000 tons of rock every single day. Here's a number that surprises most people. In a typical modern gold mine, 1 ton of rock, roughly the weight of a small car, might contain only 2 or 3 grams of gold. 2 or 3 grams is about the weight of a few paper clips. That's the payoff for digging up, crushing, and chemically processing an entire car's worth of rock. That rock gets blasted loose, loaded onto trucks, hauled to a processing plant, crushed down into something closer to gravel, then ground even finer into something closer to powder. From there, chemicals, most commonly a cyanide solution, are used to dissolve the gold out of that crushed rock in a process that can take days. What comes out of the other end is not a shiny bar. It's a muddy, valuable slurry that then has to go through several more stages of refining before it becomes the kind of gold bar you picture when someone says the word gold. And recovery itself isn't even perfect. Depending on the method used, mines typically recover somewhere between 80 and 95% of the gold that's technically in the rock. The rest is lost in the process, so even the gold you can prove is there, you don't fully get. Quick question before we go further, because I'm genuinely curious. If gold suddenly wasn't valuable anymore tomorrow, what do you think people would start hoarding instead? Drop your answer in the comments, I read them. And if you're already down there, tapping like and subscribe helps this channel more than you'd think. Okay, back to the puzzle. This is where revenue finally enters the picture. Revenue is simple in concept. Ounces produced multiplied by the price per ounce. If a mine produces 200,000 ounces in a year and gold is trading at $2,000 an ounce, that's $400 million in revenue. Sounds fantastic. But revenue is not profit. Revenue is just the top of a very tall staircase, and the company has to walk all the way down before we find out what's actually left at the bottom. The first big cost is what the industry calls the all-in sustaining cost, essentially how much it costs the company to produce each single ounce of gold all in. That includes labor for hundreds or thousands of workers, the enormous energy bills for running crushers, mills, and machinery around the clock, fuel for the trucks and equipment, the chemicals used in processing, and even the ongoing spending needed just to keep the mine running years from now, not only today. Depending on the mine, this cost per ounce might land somewhere between $1,000 and $1,600, and it has climbed a lot over the last several years as fuel, labor, and equipment have all gotten more expensive. So using our earlier example, if gold sells for $2,000 an ounce and it costs the company $1,400 to produce that ounce, the mine keeps $600 in gross profit per ounce. Multiply that by 200,000 ounces and you get $120 million. Suddenly that $400 million in revenue looks a lot smaller. And we're still not done because governments want their share too. Royalties and corporate income taxes can easily take away another 10 to 30% of what's left, depending on the country. Add in sustaining capital to keep the mine running, plus interest payments on the debt used to build it in the first place, and what started as $400 million might shrink down to something like $60 or $80 million in real annual profit. And remember, that's after already spending $1 billion just to build the thing. Here's where things get genuinely interesting, because gold mining profit isn't stable. It swings wildly. Picture our mine again. It costs $1,400 to produce each ounce. If gold prices jump to $2,500, that profit per ounce doesn't just go up by 25%, it nearly doubles from $600 to $1,100 because the cost side barely moves while the revenue side surges. But that same math works brutally in reverse. If gold prices fall to $1,500, that $600 profit margin collapses to just $100 per ounce. A relatively small drop in gold price can wipe out the vast majority of a mine's profit. And if gold falls below the cost of production entirely, the mine starts losing money on every single ounce it digs up, even though the gold in the ground never stopped being valuable. The rock didn't change. Only the price did, and that alone was enough to turn a profitable mine into a money-losing one. This is our opening puzzle, finally making sense. A mine can sit on billions of dollars of gold, calculated at today's price, and still be a terrible business, because what actually matters isn't the value of the gold sitting underground. It's the difference between what it costs to bring each ounce to the surface and what the market is willing to pay for it at that exact moment. There's one more twist working against every gold mine, even a great one. It's a business built on a countdown. Every ounce pulled out of the ground is an ounce that no longer exists in that mine. This is called depletion, and it's unavoidable. That's why gold mining companies are constantly spending money on exploration long before the current mine runs dry, or the entire company eventually shrinks to nothing, no matter how well the existing mine performed. Now, here's the twist most people watching the gold price on the news never think about. And once you see it, this entire industry starts to look completely different. That gap we've been talking about, the space between cost and price, is not something a mining company can lock in and count on. It swings constantly, and often violently, based on interest rate decisions, currency movements, geopolitical tension, or just how nervous investors feel on a given week. A company can spend a decade and hundreds of millions of dollars finding a deposit and building the infrastructure to reach it, and only then discover whether prices will cooperate once it's finally ready to produce. This is exactly the risk that gave rise to one of the smartest, least talked about business models in the entire industry. And once you understand it, it completely reframes who the real winners in gold mining actually are. Picture a mining company that has found a promising deposit but doesn't have enough cash to build the mine. Traditionally, it has two rough options. borrow the money and pay interest for years, or sell shares and hand over a piece of ownership permanently. Both are expensive, and both come with strings attached. There's a third option, and it's where the real quiet fortunes in this industry get built. A specialized type of company, sometimes called a royalty company and sometimes called a streaming company, will hand the mining company a large sum of cash up front, sometimes hundreds of millions of dollars, in exchange for the right to buy a slice of that mine's future gold production for the entire life of the mine at a price locked in today. Often somewhere in the range of a few $100s an ounce, regardless of what gold is trading for years or even decades from now. The mining company gets the cash it desperately needs without giving up ownership and without taking on traditional debt. The royalty company gets the right to buy gold for the rest of that mine's life at a price that will almost certainly look absurdly cheap once inflation and rising gold prices have had a decade or two to work. Think about what that actually means. The royalty company never operates a single piece of mining equipment. It never manages a workforce, never worries about a tunnel collapsing, never has to figure out how to move more rock as ore grades decline. Its only real job is picking good deals to invest in at the start, then collecting gold or cash tied to gold for years afterward. Some of these companies run profit margins north of 70, even 90%, a level that would be almost unheard of for an actual mining operation covered in dust and diesel fumes. The largest of these companies now carry market values in the tens of billions of dollars, without a single mine to their name. This is the sharpest version of the whole story. Two businesses, both completely dependent on the price of gold, sitting at opposite ends of the risk spectrum. One digs, blasts, and processes rock every single day, fighting declining ore grades and rising costs just to protect a gap between cost and price that can shrink without warning. The other simply signed a contract years ago, locked in a price, and now sits back collecting the difference, year after year, while somebody else deals with the mud, the machinery, and the mountain. It's worth asking why more mining companies don't just avoid this risk entirely by locking in tomorrow's gold price today through something called hedging. They can, but most of the larger, better-funded gold miners deliberately avoid it, and the reason says a lot about who actually invests in gold companies. Investors who buy gold mining stocks are usually doing it specifically because they want exposure to rising gold prices. A company that locks in today's price for the next 5 years has effectively removed the one thing its shareholders showed up for. So the industry lives with a strange tension. Hedging would make individual mines safer, but doing too much of it can make the stock less attractive to the very people funding the business. There's an uncomfortable side to this industry worth being honest about too. The cyanide used to separate gold from crushed rock has to be stored and disposed of extremely carefully. And when tailings dams, the massive earthen walls holding back leftover mud and chemical waste, fail, the environmental damage to nearby rivers and communities can be devastating and long-lasting. Large-scale mining also frequently happens in or near communities that see very little of the profit flowing out of the ground beneath them. None of this shows up in a company's cost per ounce number, but it's very much part of the real cost of getting gold out of the ground. So what actually separates an exceptional gold mine from a mediocre one? High ore grade. Low all-in production costs relative to the current gold price. Manageable debt. Efficient scale. So fixed costs spread across large production volumes. And political stability. So the rules of the game don't change halfway through the deal. A mine that scores well on all of these can generate extraordinary profits, especially when gold prices are strong. A mine that scores poorly on most of them can be sitting on a genuine fortune of gold and still struggle to survive. And that's the real lesson hiding inside this entire business. Gold mining was never really about how much gold exists underground. It's about the gap between what it costs to bring each ounce to the surface and what someone is willing to pay for it once it gets there. Everything else, the drilling, the trucks, the crushers, the chemicals, the workers, the debt, the taxes, the royalties, all of it exists inside that narrow gap. Which brings us back to that $4 billion gold deposit sitting quietly underground, technically worth a fortune, potentially earning nobody a single dollar. The gold was never the hard part. Turning it into profit is. And somewhere else, quietly, a company that has never touched a shovel is cashing a check for gold it agreed to buy at yesterday's prices.